Let's start with a fundamental question about market microstructure. What happens to the massive institutional orders that get left behind? Seriously, think about it for a second. Large financial institutions, we're talking central banks, sovereign wealth funds, tier one investment firms, they cannot just click buy or sell on massive orders instantly. If they execute it all at once, they'd cause severe slippage and completely ruin their own entry prices. So, here is our roadmap for this explainer to figure out exactly how they handle this. We'll quickly cover the institutional footprint. What is a mitigation block? Mitigation versus breaker blocks, bullish and bearish variations, and finally, the trading playbook. We're basically taking these smart money concepts and turning them into a practical, highly usable strategy. All right, part one, the institutional footprint. Because institutions can't enter the market in one giant swoop, their algorithms systematically fragment those large orders into smaller, localized blocks. They distribute them across specific price ranges where liquidity is already clustered. And because of this algorithmic fragmentation, a portion of their massive orders inevitably gets left behind, partially unfilled. Well, those unfilled orders simply have to be reconciled later. Which brings us to part two. What exactly is a mitigation block? Here is your core definition. A mitigation block is a broken order block formed after a failure swing, where institutions return to rebalance unfilled orders before continuing the original trend. The crucial concept here is that it's a second chance entry. When smart money initiated that original move, they just couldn't get fully filled. So, when the price returns to this block, those remaining orders get mitigated or completed, delivering the next leg in that original direction. But, and this is a big but, to have a valid mitigation block, you absolutely must have what is called a failure swing. This is a failed attempt to continue the trend, forming a lower high or a higher low without a liquidity sweep. Let me be super clear about this. A mitigation block absolutely relies on this structural exhaustion. The market tries to push to a new higher low, runs out of steam, and totally fails to sweep liquidity. That failure, that is your primary signal. You can actually see how the market attempts to push higher, but forms a lower high, completely failing to sweep the previous liquidity. Then, the price just breaks down, shifting the market structure, only to return upward back to that original order block zone. That return is the mitigation. That is exactly where smart money steps back in to manage their exposure. All right, let's jump into part three, mitigation versus breaker blocks. This is a huge hurdle for a lot of traders. Look really closely at this distinction. A mitigation block is a continuation setup where the trend halts. A breaker block, on the other hand, is a reversal setup where the trend breaks. I want to state firmly that while both of these patterns involve retesting an old order block, they dictate entirely opposite trade directions. A mitigation block means you're trading in the exact same direction as the original block. A breaker means the original block failed and you're now trading against it. Let's just walk through this side-by-side technical data. If you take notes, this is the cheat sheet you're going to want to remember. Notice that a mitigation block has no initial liquidity sweep, right? But a breaker block does. The trade direction for a mitigation is the same as the original order block. For a breaker, it's the exact opposite. And finally, the body close test. In a mitigation block, the order block extreme holds, whereas in a breaker block, the price body actually closes past that extreme. I really want to emphasize this point right here. The body close diagnostic is quite literally everything. Mitigation means the price respects the order block extreme. Breaker means the price body closes past the order block extreme. You are looking at the exact same level on your chart, but depending on how that candle body closes, it's a completely opposite trade idea. Checking for a candle body close past the extreme is hands down the single most important diagnostic tool to separate the two setups. Okay, part four, bullish and bearish variations. The anatomy of the block essentially just mirrors itself. So, a bullish mitigation happens in an uptrend where price retests the last down candle before a rally. A bearish mitigation happens in a downtrend where price retests the last up candle before a drop. The mechanics are identical, but the prevailing daily bias of the market absolutely must dictate which setup you're actually looking for. The crucial point is captured perfectly right here. Mitigations are continuation traits. They only work when the original OB direction matches the higher timeframe bias. The major takeaway is simple but vital. Never force a mitigation block trade against the overarching daily trend. Counter bias mitigations fail way more often than aligned ones. Just don't do it. All right, let's get into part 5 and build out the trading playbook.
Let's read through this exact sequence step by step. Step 1. Identify a valid order block on a higher time frame. Step 2. Wait for the failure swing and the retrace back to the zone. Step 3. Drop to a lower time frame, like a 3 or 5 minute chart, for confirmation. You're specifically looking for a market structure shift here. Step 4. Execute the trade right at the order block tap. And Step 5. Place your stop loss with a buffer beyond the extreme. Remember, discipline right here is the absolute key to risk management.
Let's look a little closer at that stop loss placement. You must place it beyond the order block extreme. So, above the high for a bearish setup, or below the low for a bullish setup, but with a small buffer. I gotta warn you, and look, we've all been there. Stop losses placed exactly 1 pip past the block get tagged routinely by the spread on the retest spike. You have to give the market a little room to breathe.
And let's see how this builds into timing, because timing is just as crucial as price action. Institutional algorithms are highly active during specific periods known as ICT kill zones. The London kill zone is highly reliable for mitigations, and so is the New York kill zone. You should also definitely watch for a sweep of the Asian session highs or lows prior to the setup forming. Remember, the right setup at the wrong time is still a losing trade.
Let's rapid fire through some common mistakes to make sure you protect your trading capital and avoid low probability setups. First, do not confuse a mitigation with a breaker. Always run that body close test. Second, never trade against the higher timeframe daily bias. Third, avoid entering purely on a wick touch without waiting for lower timeframe confirmation. Fourth, don't place your stop losses too tight without a buffer. And finally, never force the setup in choppy or range-bound markets. Mitigations require a clear trend to function properly. Which brings us to our final thought. As algorithmic execution continues to evolve, how will these institutional footprints shape the charts of tomorrow? While the algorithms might get faster, the fundamental need for massive institutions to rebalance and mitigate their exposure isn't going anywhere anytime soon. I challenge you to take these concepts to your own charts, hunt for those failure swings, and continue mastering the market's microstructure. It is a real game changer and will completely change how you view price action. Thanks for joining me on this explainer, and happy studying.